On AVXL, I'm not sure. I think it deserves a short position in pretty much everyone's portfolio, at least as a small amount. In terms of sizing and timing, what I like to do for things like this where you know it's early, and maybe I should have done this with quantum, is, I don't know, say this is January, April, July. Okay. So if you, let's say the stock price is arbitrary X, your position size, I'll draw in green. Basically, your plan is you sort of rise some sub-asymptotically, I guess, sub-exponentially. So you try to grow your position if you don't know when the catalyst is going to be, which I think is the case here, you start with a small position and you sort of grow. So this is sizing. Now the price, you don't know, as quants say, returns are randomly distributed. So you don't know when the actual price is going to drop. It may even rise, right? So you assume this price sort of takes a random walk and eventually craters. We draw another random walk here as an early crater. We'll draw another random walk here. It's kind of a late crater. So the way I look at this is practically I'm happy if I have a small position and it immediately craters. My IRR is pretty high. Let's say it's up here. Now my IRR is dropping. Well, if I make, what's the IRR here? It's not exactly dropping, but let's see. Well, yeah, it is dropping because let's say the event already happened in this fictional world. And then it sort of bumps up again here and it bumps up again here. So that's the kind of nature of IRRs with these things. You might have this tiny position. You say, oh, that sucks. I have this tiny position. And the stock dropped really quickly. Well, that's a good thing. You know, even if you had a 1% position, if it dropped 80% or something, you made 80 basis points in, I don't know, a month or something. That's a 12% ARR. Depends on your risk tolerance, right? Whatever it is, N%. Then you say 2N% and then 5N%. So maybe your risk tolerance is higher and N is 10%, in which case you made 8%, in which that's a 120% ARR. And here, it took twice as long. This is the 6-month outcome, right? So, but you had 2N, so you have a 20% position. So you may say you made 16% notional, 32%. And then at the 5x, you made 40%. So IRR here is something like this. So you're almost happier if it comes early, even though it's a small position, paradoxically. And again, you could adjust these as you see fit. Just make sure you stick to the plan, which most people do not, including myself, and think that through. But yeah, you shouldn't mind it coming early, of course. And the longer it takes, you still want some kind of exposure early, even, and then just increasing it a little bit each month as the decision nears. Well, I'm still bleeding. If it wasn't for some of the calls I own, I would have been blown up a million times over. But my hope was that, so basically, you're buying the stock, it's doing this. If you short the stock and you buy, I don't know, let's say, while it's here, you buy these calls. These are the calls you buy on this date. And the calls you're buying are these strikes. All right, well, these calls won't be worth much. They'll be the cheapest, though. So it's 5 cents. These are 20 cents. These are $1. These are $2. Something like this, okay? So you're short the stock. You're betting the stock goes down. Let's say you're short 100,000 shares. Round numbers. You know, I don't know, let's say at this price, it's a $7 stock. What you might want to do, 700 calls. So if you have 700 calls, that's like, they're 100 share lots. So that's like owning 70,000 shares. But you're doing that across this. So the delta on these is like 10% delta. I call this 15% delta. These are all out of the money. So these would be like 30% delta, 50% delta, something like this. And so the actual delta hedge, when you apply it, is even less than 70,000 shares. So you could increase this. You could make this 100,000 shares. So like here, theoretically, your max risk is whatever the price of this call is. So there's a lot of ways to sort of lock in losses, if you will, as a protective measurement. One really funny payout possibility is if you did something like this, 200,000 shares or something like that in calls, then you actually have this weird payout where if this price is 0, this price is infinity, you actually get this bizarre payout where you make money if the stock goes crazy. No, there's times to call it quits. I mean, I think it depends. Each short is different. Like, there's shorts like this where there are really not any fundamentals. It's just the market going crazy. I think that's a very different world than when you're short like a company that's growing and you thought they were overvalued, but they had a really good quarter or something like that. Those are really different from something like this when it's like just parabolic up. They almost always go parabolic down. It's just a question of when. The way I like to think things is like if you're willing to short or long 5% of the portfolio, let's say, you put it in and you say, I'm not going to look at this stock for 2 weeks. You know, that's probably the better way to think about it. But look, I mean, it's very rare to see a stock go from 10 to 17 in 2 days with no news. It's almost certainly going to go back down. It's just a question of like, you want to be the bull who shorted and taking all this pain when, you know, you don't have to be. I don't have to, 1, 2. I don't know. I mean, I really like the quantum shorts. But the whole point of the market is that you don't have to, right? That's the entire point of the stock market. That's the one thing Warren Buffett wants to leave this world teaching us is you don't have to swing at every pitch. So if you didn't swing at Rigetti at 11, now you can swing at it at 17. You got to keep buying calls. Estimate how much theta you're willing to burn. You willing to burn your whole account? Well, that'll get you the most upside if you're right. You're not willing to burn your whole account? It'll be less upside, but you'll be safer. Your call. I think you can give up on a short either at a certain price point, and you say, I'll reevaluate this at some other time. It's like a time stop out. Or you might give up on it if the fundamentals improve or something like that. Your thesis has changed. There's a couple of reasons. Usually you should have some instinct. Like I've given up on DJT somewhat temporarily. I will revisit it. Instinct helps a lot. I try to do as much as I can, Jerome. Probably the biggest losses I've ever made, almost always, are in impulsive moves. Where I just say, I want to do this because I feel like it, as opposed to, I want to do it because I should do it. And I think that's something that a lot of people have a problem with. Really good traders don't have a problem with that. But you also have to have conviction. You have to be willing to make the bet when the opportunity is there. And you got to be willing to look stupid sometimes. If you're only willing to look right every time, well, you're going to get 2 trades a year, like the 𝗂𝗍𝗪s and the 𝗏𝗁s. And if you're happy with 2 trades a year that work, then by all means. Notice that those are all good contrarian picks. I'm just not in the market so day to day that it's my day job. Otherwise, I almost always win those contests. Of course, Rigetti had a little bounce there. But this is where you put out, if you were buying hedges, now you can sell some stock against it, or delever. And you're just trying to keep the bid-ask. You don't want to lose money on bid-ask crossings, if that makes sense. But you're trying to take advantage of volatility instead of having it take advantage of you. Now, you're always going to have some directional angle. Some people don't. Market makers don't. As it rallies a little, I might want to sell some of my hedges. And if it dips, I'll buy some back. That's kind of the idea. And I get to roll. Different strikes have different deltas. So right now, little bump, you might want to sell your high deltas. And on a dip, you might want to buy your low deltas. And of course, you have common stock as a tool. Again, it's not going to save your, well, depending on how you set your hedges up. So to give you a concrete example, I guess I can try to give you a concrete example. I'll sort of try to do the math on the fly, but let's say, here, let's say 𝗥𝗘𝗖 is 18.35, which is the current price. 𝗥𝗘𝗖 17 calls, they're about to expire, right? They'll be trading at 135 to, and they'll update, you know, so when this is 139, fair value of this should be 139. When it's 1839, should be 110. That sort of makes sense, right? So you have to sort of play these values against each other. So now we're short 𝗥𝗘𝗖. Let's say we're short 1,000 shares at 1839. That's $18,390. Let's say we're long these 17 calls. I don't know. Let's say we're long 5 calls. That makes sense. That's 500 shares notional. And so that's $1. Say we bought that for $1.35. Well, this is what 5 times 135. 675. That's right. 500 times 17. What are we doing here? Well, yeah, I guess we could just do the value, I guess. $675. So every dollar 𝗥𝗘𝗖 goes up, this should go up $1 too, because this is in essence, a 100% delta, right? So if 𝗥𝗘𝗖 goes up 1939, you lose $1,000 on that, but you would this would be, you would lose $500. You would make $500 on this, so you would net lose. But at that price, maybe you'd want to say, you know what, I'll sell these. So sold 5 calls, book $500 profit, and because this is so volatile, maybe you'll get another chance to buy this hedge back down here. Bought these.
Order filled.
And, you know, ideally you can have some volatility will help you get out of your position. Now, let's say you round trip this to this twice.
Order filled.
Well, now, you know, you have basically have these calls for free, if that makes sense. Now, it's options expiry, so delta is 100. It's not 100 when it's not options expiry. So these things will move less because there's less expiry. They'll move less depending on their delta. There's a lot to it, but the basic idea of being a vol trader is that. Now, we have a directional bet, but it doesn't mean we can't make some money on the vol as well. And it could slightly offset the losses from the vol, and I'm sorry, from the direction. And huge amounts of volatility is sort of a trader's best friend. You have a lot of options. If, you know, I luckily put on some hedges earlier in the 18 range. Those hedges are up a lot in some cases. So you sell them and now you're back to short position. Now, whether or not you'll be able to buy them back again depends, and you have to have a nose for it. It's certainly not easy. A little bit of luck helps too, but we obviously want the market to drop for these stocks. But even trading small amounts of hedges can add a little profit to your mix. And it's not gonna, like I said, it's gonna soften a blow. You're not gonna be happy about it, but you're fighting to stay in the short another day. Every day you get to stay in the short, you get to hopefully get that big downside when the crash happens. IonQ was up 10% for no reason. 𝗥𝗘𝗖 was up 25% yesterday for no reason. $11 a week ago. 11. 19 right now. 14 just 3 or 4 sessions ago. No news. Nothing has changed. Google Quantum is interesting, but like I said, even people at Google Quantum are skeptical. Google PR team just kind of hit it out of the park with this one. The whole internet talking about parallel universes. Like, what? I showed you the factoring. We factored, what do we factor, 15 into 3 and 5? Another concept, just so everybody understands how the hedging strategy works. I think I went over this, we'll just go over it again. Let's say you're long, let's say you're short 10,000 shares of IonQ, 47.28. What is that? $470,280. Pick a different portfolio size. A little bigger than last time. Some of you have big portfolios, some of you have small portfolios. Doesn't really matter. You want to hedge this, or maybe you don't have the margin for this. Either way, you say, you know what, I'll go long exactly 100 IonQ calls, the 35 calls that expire next week, okay? And those should be priced at, what, 12.20. Now, maybe you have to pay 12.30 because you're crossing the bid-ask, or there's some implied vol. There shouldn't be much implied vol this deep in the money. Let's say there is. And you're paying 12.20 or 12.30. 2 cents of implied vol, not much. And again, we have, well, we could do the math on this. This is $1,230 times 100. So 12.30 and 2 zeros. So you're long that much. Okay. Now, do you know what the profit payout for this is? Again, you can use an options calculator or do it in Excel yourself. But basically, what happens if the stock goes to, say, 30?
𝗠𝗏𝗍𝗘.
Now, will IonQ go to 30? You know, that doesn't necessarily seem like likely to happen, but you basically get kind of this free short. So this part, right, well, we know how to do this. At 30, this is $300,000, so you made $172,280. Your long calls are worthless, right? Your calls are worth nothing. Now, depending on the day that trade, potentially that stock drops, you could have some residual value on those calls, theoretically. But let's assume it's worth nothing. And so in this case, you lose $123,000 and on the calls, but you made 170 on the short, so you netted out 53K. Now, what happens if the stock goes to 60, which, given this rally, we know might and could happen? Well, let's take a look. At 60, you've lost a lot of money. You've lost $130,000 roughly. But your calls went up. That's on your common stock. On your calls, what are your 35 calls worth at 60? They're worth $25. That's $250,000. You bought those for $123,000. So you're up 130. You didn't lose any money at all. Not bad. So now the stock has to get creamed for you to make any money here. The stock may not get creamed. But what if this was at $40 or $45 or $43, and you have to run the math on those? And you can kind of get some outsized downside without having a big upside risk. But in general, it's going to be very hard to do. There's no free lunch in the markets, right? There's no free lunch at all. There never has been, never will be. But depending on what it is what bet you're trying to make, you can kind of make them happen. You had a small rally in these stocks, good time to sell some of the hedges you bought. It was back down, you can buy them back. Occasionally, hedges that you really didn't expect to be worth anything end up worth a lot. Like today, I had these IonQ 45 calls that were like 10 cents or 20 cents yesterday. As you would expect, the stock was like 43 or 42. Why would the 45 calls be worth anything? Well, they were 25 cents yesterday. Now they're like $2 or $3. And I was able to sell those, which gave me enough profit to not get totally annihilated today. Now, you do limit your upside. If the stock drops a little bit, you still don't make tons of money. But you can mix and match these hedges. You don't have to have them all in the same strike price.
𝗠𝗏𝗍𝗘.
You can have some at this strike, some at that strike. And you can kind of keep rolling it as you see fit. So I sometimes call this taming the beast, but for now, the beast sure tamed me. But
𝗠𝗏𝗍𝗘.
you know, if you can hold on, hang tough, you might be able to do it. The bid-ask spread between in the calls and puts is what Jane Street and 2 sigma and Susquehanna and Citadel, that's where they win. For example, if you're bullish on IonQ, they will sell you an option that's maybe 5 or 10 cents too pricey. And they'll go delta hedge.
Order cancel.
They'll do exactly what I just showed you on that screen to avoid losing money. The only way they can lose money is if there's a really crazy event. And the way they do that is they delta hedge. So there's 5% chance that happens, well, I'll short 5% of the stock. And that's where you guys hear about gamma squeezes and stuff like that. You can sort of artificially induce the market maker to take a directional bet that they don't want to take by buying really out of the money calls. Yeah, I do expect them to kind of gap down at some point. We've seen this before. I think all of you have seen that before. Yeah, I want to roll some hedges and put some on, but I don't. The higher the strike price, the more implied vol you got to pay. The lower the strike price, the less implied vol you got to pay. So the idea behind these hedges is that I think you guys understand it, but they sort of act as synthetic puts. So when I buy these calls, I'm really hoping they all go to 0, but I have to get delta hedged. And putting on the delta hedge has slippage because Jane Street and 2 sigma and Citadel are very good at this, and I'm not. I'm one guy clicking a button. It's not the same. And so they'll put on their delta hedge faster and better than me. Now, on the flip side, I have alpha. They don't. And so they have less alpha, I think. But, you know, so they get their hedge on, they make a cent or two. I put on the, you know, put on my position and hope the synthetic puts print. Now, if you pay a lot, which I'm unfortunately doing right now, because these stocks have moved so much, you have to pay a lot to put this position on. But if you pay a lot, you can lose money on it like anything else. But the synthetic put only pays if there's a large drop in the stock price, similar to a normal put. But unlike a normal put, you can kind of leverage a synthetic put, whereas you can't really leverage a normal put. When these stocks go down, I try to buy out of the money calls, and I have just
partially filled.
A lot of calls.
Order filled.
I actually wish I had more.
Order partially filled.
Given how up they
Order
are.
Filled.
I it's funny because I have no like real exact calculations on any of. You would think I'd be sitting there calculating my deltas very carefully, all this stuff. I'm like, I just sit there and click.
Order filled.
I click short. I buy the calls, and I don't want to sell the calls even though they're up a lot, because that's what gives me the buying power to sell it.
Order filled.
I just basically go off my buying power and my P&L, which is definitely not the way to do it.
Order partially filled.
Well, one thing I could do is I could sell the out of the monies, okay, and buy in the monies with the proceeds. But then I just want to short more anyway. So that way I'm like selling the vol, the highest delta that's going up, if that makes sense. I don't know. Another good strat is to trade the calls pretty actively, like trade 50, 100, 200 calls at a time, just back and forth. Okay, I'm selling some of my calls. Yeah, maybe down like $50,000 today. Really almost nothing. So I'm very lucky that I have these calls. Well, you generate profit on the way down because your puts gain delta, or as the stock goes down, your calls lose delta. And so you get more short as the stock goes down because your short common stays 100% delta, but your calls have a blend of delta going from 100% to 0%. And as I guess I can show you. So let's say you got your short just has payoff like this, right? So this is, let's say, the current stock price. And this is your P&L is break even. This is the current stock price. Let's say it's 39. So I don't know, 45. Actually, let's make this 55. Okay, so your calls, these calls have 100% delta. These calls have 50% delta. And theoretically, these calls have 0% delta. And you have a sliding scale. You've seen my position. It's every option in the chain I've got. And so here's the interesting part. As this line moves, as this curve shifts, what happens to all these deltas? So if this is the new line, what happens to all these deltas? When stock goes down and I'm shorted, I like to cover it. I don't know about you, but you had the same opportunity to cover it that I did. I don't have access to a special stock market. We're the same stock market. I even said on Godel I'm covering. The deltas don't increase. No, the other way around. The deltas decrease. So this same call, let's say this is a 37 call. This 37 call might have had 80% delta. But as it drops, as the stock goes from 39 to 37, the delta will go from 80 to 50. So if all of your deltas drop, you know, this 100 might go to 90, the 80 might go to 70, the 60 might go to 50, etc. And the 0 stays 0. But when you delta adjust, of course, this is elementary stuff. But the point is, this is, somebody asked, 1, and 2, you know, as the stock drops even further, these deltas drop a lot. That's why you can make a ton of money on these, because your delta adjusted exposure, it might look like you're evenly hedged right now, but as the deltas drop, you get massively short. Because the delta adjusted exposure, say you have $100,000 of some option, or let's say you have 1,000 shares, okay? You have 1,000 shares or 1,000 options. It corresponds to 100, right? Times 100 makes it 100,000 shares. If it's at 100% delta, that covers your risk for 100,000 shares. But if the delta drops to 90%, you actually got 10,000, you shorted 10,000 more shares without doing anything, just because the delta is dropping. So that's kind of how that works, and that's why I like it. This stock has already retraced most of the parabola. So like a parabola is just a math equation. But basically, once you do this on Wall Street, like it's possible what happens, not on Wall Street, but in a stock chart. And I'm not a chart guy, but it's possible this is what happens, right? That's happened, right? But like, as you go down and down like this, you don't see usually this happen. And once you get down to like here, bro, it's over. Like you're almost certainly gonna do this or that. Especially if the volume was like really high here, and it's like, oh. So like once the parabola started to be like, okay, we reached the top, and depending on the parabola, like these were even spikier. They were like this. It's like once you're down here, like nobody's buying this relief rally. Like there's no fundamentals. So you know, you have to take the fundamentals into context too. And I hate charts. You guys know that. I hate looking at charts. I almost never look at charts. But when I think about it, I'm just like, once the parabola starts, it's almost a self-fulfilling prophecy. Because what ends up happening is the people that bought up here, we have a name for them at this channel, the people that bought up here, down here, they feel really stupid. And they may either get margin called, some of them will buy more, some of them sell, some of them hold. But like ultimately it results in a self-propagating process that results in kind of a drop. And I know that's self-evident, but the thing about, I guess the thing about it that was interesting to me was that IonQ, okay, was like at the time, this morning when I had to make my decision, IonQ was like this. And we all have seen stocks that have rallied like from there, right? We've all seen that. It happens all the time. You think you got the short, it has a small fade, and it just recovers and goes up even higher. In fact, that happened to us with Rigetti and other stocks, many other stocks. It almost happened to us with Sava, it happened with 𝗣𝗍𝗄𝗃. Like, it's just what happens. But I said to myself, okay, that's true for IonQ, but if this other stock, QSI, has already done this, one of two things is going to happen. Either they all come back at once, or IonQ is just a laggard and it's going to drop the same way QSI is dropping. And I said, there's no way that QSI doesn't make widows out of everybody that bought it, because QSI is not even a quantum company. It's just a little company that has the word quantum in it. So if that stock's down and recovered most of its parabolic move up, then IonQ has to match it at some point. So anyway, that was my thinking when I came to that. Some of you this morning probably heard me on Godel saying, what's going to happen? Like, is this just something where we cover and like fight this stock for the next 6 months? Or is this something where it's over? And that's kind of the clue that helped me, this LAES. Look at LAES. I mean, it's like almost completely, you know, the parabola topped at 11. It's at 4. I mean, that's a 60, 70% peak to trough in a few days. to me, it wasn't likely that this would recover. Although, we probably have seen it once or twice in the history of the markets, but it just doesn't seem like that was going to recover and INQ would recover and all these other stocks would recover. It seemed more likely that INQ would just come down as well. So that's how I made that decision. Again, 6 cents, maybe just random, who knows. I also have been increasingly bearish. There's a nice chart the other day, forward PE and returns.
Partially filled.
S&P returns, sort of a correlation between forward PE and S&P returns. It was on X. This is it. Wow, that worked actually really, really well. So this is I guess I should have retweeted it. So this is the current forward PE for the S&P 500 is somewhere like this, 23 times. And you can see the next 10 years, what the average returns are. They're zero or negative. And the point I've been making for a while is if you have two back-to-back 25% up years back-to-back, what are you going to do? Have another 25% up year? Markets don't work that way. Stock markets don't work that way. They're never that good. The only time markets do really, really well is after a period of kind of a lull. And we just went up 50, 60%. Like, we can't keep going up. I mean, anything can happen, but it's a bit of a scary thing. And then I was also scared seeing the DJTs, the stuff happening in crypto with meme coins, the stuff happening with quantum, the stuff happening occasionally with biotech, AI, like SoundHound, that's not even AI, MicroStrategy, like all this stuff is bubble. Eventually, bubble has to burst. The Kelly criterion says that it's actually mathematically proven to maximize your bankroll or your portfolio size, your P&L, you're supposed to put the most amount of money in your highest conviction trades. If you actually employ the Kelly criteria, most people in Wall Street, the Kelly criterion, most people in Wall Street find that it leads to positions that are too large. It's a pretty simple probability, and so for determining bet size. Now the thing about options is they allow you to construct interesting bet sizes. So I use the method of synthetic puts to make a healthy P&L. I'm up a lot today. James made a good point here, which is like multiple outcomes and risk reward have to be implemented within Kelly, which makes it hard to implement. But in any event, if you can find a way that's creative that can limit your risk, I think that's one of the keys here. And I think the other key thing is if you're willing to take pain on the way up, you should be willing to be greedy on the way down. And that's one of the hardest lessons I've had to learn. I was very good at taking pain on shorting, and as a long too. Really, really good at it. The thing I wasn't so good at is when I finally start to get paid, I would get out of my whole position like right away. And my trading partner, my business partner, Mark, he would laugh at me and he'd say, so you're willing to ride the stock as a short from 5 to 40. And the second it goes from 40 to 35, you want out. If you're short it all the way up there because you thought it was going to go from 5 to 1. If anything, you should be adding to it because the market's finally starting to see what you see. You see things early because that's what your gift is. The rest of the world's going to have to wait to catch up to you because you're just a different kind of cat. This was more of a story about risk management and tolerating a short that's ripping in your face. And shorting after it starts ripping in your face. So here's 𝗥𝗘𝗍𝗍, right? It feels like some big victory today, but it's not. If you look at the stock price, I was shorting at 13. This stock is going to go back to 3. Once a parabola goes up like that and breaks, it doesn't get better. It doesn't recover. So this is the time to short it when it's safer. I'd rather make 13 to 5 free money than struggle on the way up to 20. Now, I'm not the kind of guy that is willing to do that. I'm willing to be a little early. But the reality is you should wait for the break. The break has happened, right? And now you short it. You're still going to make 80, 90%. I'm going to make 80, 90%, but I'm going to make it with all the stress and pain and difficulty. I generally don't sell calls if I've used them as synthetic puts because they don't do it doesn't do anything for you when you sell them. So the out of the money calls are all going to be worthless. I might even buy some just to have further protection and short more. I mean, like I said, it feels like the trade is over, but the reality is like that's just because you took so much mental damage shorting them. IonQ barely is down, even though it's down 20%. It's at the same price that was causing me a heart attack a week ago when I was shorting it like crazy. Now I want to cover it? No, I'm not going to cover. Why not short more? Well, again, I have to tell you guys, even though I've taken my account from 100,000 to over 2 million in the last 3 or 4 months, that I'm actually not a great trader. I want to be clear about that. I know that sounds strange. Most people would like to have those kinds of results, but I think that the risks I took in that account were so high. There was a time when I felt like I was going to have Quantum's only been up for about 2 months, so we called it at the time, and those stocks went on a huge run, and obviously they came back down. I'm not saying I'm not a good investor. I'll take the credit for that. But I think that a good trader limits their risk. I think that's probably one of the biggest things. But, it kind of reminds me of the Beatles. One of those, I think it was Lennon or McCartney said that, a great musician knows when to break the rules. Otherwise, if you stay in key every note, it's a boring song. It's when you go out of key for one note, that's what makes the song beautiful. I think that for trading, you generally never want to go out of key. Limit your risk, limit your risk, limit your risk. That's the general idea of trading, is always limit your risk, take stop losses. I don't do stop losses very well. I set up kind of some risk limits, but there are a lot of trades I put on where I say implicitly or explicitly ahead of time, I'm willing to lose it all. And a good trader does not do that. A good trader would never do that. And so I think that the P&L of a good trader looks kind of like this. It looks kind of like this, okay? And the P&L of someone like me, at least lately, it sort of looked like this. And, obviously, which one would you rather be? At this moment in time, yeah, the green line's ahead of the black line. But at what point, at this point, you feel like yourself. At this point, you think you're God. I think the black line's a better line. I trade stocks. I do options too. Yeah, I think I'll take that, Wiz. Again, all these are really good trader questions, and if there's anything I'm really good at is fundamental analysis. I know people want to be great traders. There's no better thing than being a great trader. But the problem is the amount of people who are good traders are very, 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 very low. And there's a lot of LARPing going on. And I'm not going to LARP to you guys. The amount of people I can call a good trader that I know personally and I've worked with or work with now, it's like 2 or 3 people, man. It's not a lot of people. And even those people have self-doubts here and there and have cold runs. Being an analyst is easier. But the problem with being an analyst is, a lot of people can do it. It's not that hard, and that's what I'm sort of showing you guys. But the person that has to execute the trades, that person has to have a lot of discipline, a lot of risk management. One of the lessons that I've learned over time about psychology, and I've said this before in these streams, is that smart people have a really hard time trading. Because very smart people, and I'll put myself in that category for a minute, a little moment of hubris, but if you're above average intelligence, let's put it that way, and this kind of scales, unfortunately, what ends up happening is you become, throughout life, you've been sort of, you've gotten used to this idea that you're always right and you're very smart, and that when you are here to solve problems that you get the right answer. And the problem with that is that the stock market's a very tough problem. And you'll come across a problem like IonQ, right? And you'll say that, IonQ is a short, quantum's 30 years away at best. These machines don't work. I know a lot about quantum mechanics. I studied that as a kid. Like, you short the stock and the stock doubles. I'm still right. I have to be right. And you keep shorting it, and the stock doubles again and again and again, and you lose all your money. And you're now working for a guy named Tony and went to community college. But Tony's a good trader because Tony knows how to take risks and size his positions correctly. So Tony from Long Island doesn't know anything about quantum mechanics. He can't spell quantum mechanics. So the point is that the people who are humble, they tend to be pretty good at, and they have a special skill. Some people say they're born with it, to manage risk and manage capital. But the person who's intelligent, they want to take out their intelligence on the market. And anytime you feel like you're taking out an emotion on the market or anything, any dynamic like that, that's the dangerous thing. And some people say you're supposed to stop doing that. Some people say you can't stop doing it, so you might as well listen to it and harness it and learn the feeling. You can't change your feelings that easily, your behavior. So I think that if you try to manifest your intelligence in the stock market, it's not going to go very well. If you try to listen to the rhythms of the stock market and understand what's happening, it might go a little bit better. But the second you start putting yourself into it as the observer, it's kind of an observer effect. Speaking of quantum mechanics, you end up having an issue with like just various biases. Probably the biggest one that I've been a victim of, and I see all the time in other people, is I am so smart. If you fade that too hard, you end up becoming a slave to the price action, which a lot of quote-unquote good traders are. And that's kind of where I like to push back on the strong trader that is just sort of driven by price dynamics and money flow. I think that in this example, I probably beat that trader P&L wise, but not risk wise. So on a risk adjusted basis, they probably still won. But for me, I was willing to say, I'm shorting this to the end. I'm making a big fat bet. You're going to stop yourself out 6 times. You're going to find some other stock to trade. This is real alpha. These stocks are worth nothing. I'm ready to risk it all for this. Who's right and who's wrong in this scenario is tough to say. The trader needs people like that for alpha, but it also may not mean that trader or that the person generating that alpha should be putting in the trades and should be kind of finding a risk manager. And yeah, the market's smarter than all of us individually. So the market knows this stuff. I think that it's very hard to sort of bet against the market, say that you're smarter than the market. It's very hard. So, I mean, I think generally you should have a 1-to-1 ratio of short stock to sold calls. But the delta mix is what matters a little bit. Are you in the money, at the money, or out of the money? Long call, short stock, yes. Did I say it backwards? Not all my shorts, but my big shorts, yes. Well, then you're long vol if you're long stock and long put. And that's if you're long a stock, that makes sense. You have a synthetic call. But if you're short a stock, you want to be short the common, which has unlimited downside participation, and you're long the call, which only has limited upside participation. I don't know why Ringetti's up today specifically. If you look at IonQ, it's only up 8%. So there's nothing specific that happened to any one of these stocks. I think it's just a relief rally after some pretty bloody punishment. Yeah, Steven's got it. Those payoff diagrams help a lot in understanding them. I mean, beta is up to you. If you want high beta, you can have it. If you want low beta, you can have that too. If you want negative beta, you can have that. I think a lot of that stuff is best learned by yourself, chickens, guys, just experimenting a little bit. No alpha, no edge there, Jeremy, but it's obviously fun to some extent. It's still a gamble, And Rigetti got very punished on the downside. Again, you can see here from this chart, I mean, this stock is still down a lot from its peak. This was the pump and is down a ton. And it had this, here it was down a ton, had a relief rally. So, it could go to 10 or 11. I mean, we don't know. I doubt it. I think it'll go back down pretty quickly. But, the stock market is not predictable. In the long run, I think you can make some predictions. But this relief rally, certainly a little surprising. I don't think that's a bad idea, Korean. I do look at it a little bit. Yeah, Black-Scholes works. If you went a little over-leveraged here, you should, again, try my approach of being long calls
Market is definitely irrational day to day, tick to tick, because anything could happen. I'd say you should be able to live through your shorts going up 50% or even doubling. Collectibles is fine. I buy a lot. I buy them all over the place. I don't just buy. I buy 100 delta, 80 delta, 50 delta, 20 delta. Then whatever the brokerage lets me buy that reduces